The U.S. economy today maintains a facade of opulence built upon beams, corroded by a national debt of $38.2 trillion. This figure represents 124% of the GDP, a milestone that historically signals the decline of major economic empires. To keep the system running, the U.S. Treasury is issuing bonds at a record speed of $1 trillion every 100 days. The budget deficit for the 2024 fiscal year closed at $1.8 trillion, proving that the government spends 30% more than it collects. The largest bill in this imbalance is the net interest payments, which reached the historic mark of $1.1 trillion annually. For the first time ever, the cost of the debt has exceeded the total national defense budget, which is set at $822 billion. This means the government now spends 13% of its entire annual budget just to avoid default, without paying off a single cent of the principal balance. Interest costs now consume more resources than Medicare or the total support provided to the nation's war veterans. American families, following the government's example, have accumulated a record $18.6 trillion in total household debt. Personal debt has surged 60% over the last decade, while real wages, adjusted for inflation, grew less than 10% during that same period. The housing market is the largest pillar of this pressure, with $13.2 trillion in mortgage balances weighing down monthly budgets. With mortgage interest rates hovering above 7%, the cost of financing an average home has doubled in just 24 months. The public's reaction has been to use home equity as an ATM, driving home equity lines of credit up to $411 billion. This behavior reflects the desperation of a middle class, using their own housing as collateral to pay for current consumer expenses. The educational sector presents a structural bottleneck with $1.73 trillion in student loans that cannot be discharged in bankruptcy. 44 million Americans carry this burden, with an average monthly payment of $400, draining the consumption of durable goods. About 9% of student loan borrowers entered serious delinquency in 2024, signaling that higher education no longer guarantees a financial return. This debt delays the decision to buy a first home or start a new family by an average of 8 years. The most explosive segment of the crisis lies in credit cards, which broke the barrier of $1.15 trillion in accumulated balance. The average interest rate on these cards reached 21.5%, the highest since records began, creating a spiral of compound interest. The use of revolving credit grew 13% in 1 year, indicating that Americans are financing groceries and fuel in installments. 60% of the population claims to live paycheck to paycheck without an emergency fund exceeding $1,000. Credit card delinquency jumped to 10.7% among young people, the highest level since the 2008 crisis. The average consumer now carries $6,501 in card debt, paying hundreds of dollars just in monthly financial charges. Auto loans total $1.62 trillion, with average monthly payments surpassing the $700 mark. About 15% of new car buyers are committing more than 20% of their net income just to their vehicle payment. Auto loan interest expenses rose 34% in 2 years, forcing many owners to refinance their vehicles for terms of up to 84 months. This creates the negative equity phenomenon, where the driver owes 30% more than the car's market value. The corporate sector is also leveraged with $13.5 trillion in debt, with $2 trillion of that maturing by the end of 2026. Many of these companies are classified as zombies, as their operating profit does not even cover the cost of their current debt service. The commercial real estate market faces a $2.7 trillion crisis in loans that need to be renegotiated at much higher interest rates. With office vacancy at 19% in major cities, the risk of systemic default in regional banks is at 40%. The future outlook for the dollar is one of debt, as the government needs 3% to 4% inflation to reduce the real weight of the debt. The stealth default punishes purchasing power and reduces the real standard of living by 15% every 5 years. The central bank, the Federal Reserve, is in a dilemma where keeping rates high breaks the government and lowering rates accelerates price inflation. This fiscal dominance prevents monetary policy from being effective, making the U.S. economy sluggish and dependent on stimulus. Credit rating agencies, such as Fitch, have already downgraded the U.S. credit rating from AAA to AA+, signaling global distrust. This increases the risk premium demanded by investors, which makes the cost of living even higher for the average citizen. The rise of buy now, pay later BNPL has injected another $75 billion in untracked short-term debt. 40% of users of these platforms admit they would not be able to pay for their purchases if it weren't for the installments. The outlook for Social Security is insolvency by 2033, with an unfunded liability exceeding $100 trillion. This means current generations pay taxes for a benefit the government will not have the cash to deliver in full.
Have you ever stopped to think that the videos you just watched with flawless scripts and engaging narrations might have been created by someone who never even touched a camera or a microphone? There is a new digital elite profiting heavily behind the scenes of YouTube and social media, building massive channels without ever showing their faces or spending thousands of dollars on equipment. While most people are frozen by the fear of being on camera, these individuals are using the hidden power of artificial intelligence to generate automated content that works and earns for them 24 hours a day. The secret to dominating this game isn't about having a famous face. It's about knowing how to command the right tools to create scripts, voices, and visuals that magnetically hold the audience's attention. I've gained access to a strategic method that reveals the exact roadmap for you to build your own invisible digital empire. Mastering AI to turn clicks into a real source of income. It is the perfect opportunity for those seeking financial and geographical freedom without having to deal with the pressure of being a public figure on the internet. Best of all, you can seize this opportunity right now for a symbolic price. The complete training is under an exclusive promotion, dropping from $97 to just $17. This is your passport to unlocking the knowledge you need to start your professional journey with AI today. Click the first link in the description to secure your spot while this discount is still active.
The human reaction to these numbers is a loss of trust in institutions and an increase in social polarization over scarce resources. Financial stress is now the #1 cause of divorce and mental health issues among Americans aged 25 to 45. China has reduced its holdings in Treasury bonds to less than $800 billion, the lowest level in 14 years of records. If major foreign buyers stop financing the American deficit, domestic interest rates could skyrocket to 10% or more. For every percentage point the interest rate, the U.S. government needs an extra $300 billion just to cover the difference. This money is withdrawn from investments in basic education, healthcare, and public safety, degrading human development indices. Human beings react by becoming more conservative, which has dropped the birth rate in the United States to the lowest level in a century. Young couples claim that the cost of student debt and housing prevents them from planning for their first child. In the corporate environment, innovation has stalled because capital is being used to buy back shares and pay interest instead of research. This reduces American competitiveness against Asia, which invests 3 times more in productive infrastructure per dollar collected. The future outlook is for a painful adjustment, where taxes will have to rise 20% just to stabilize the trajectory of the national debt. However, any tax increase in a highly indebted economy could trigger a recession with unemployment above 7%. The work ethic is being replaced by financial survival, where the average American needs 2.5 jobs to maintain the standard of 1990. This degradation of free time affects social cohesion and civic participation, weakening the foundations of democracy. The government tries to mask reality with unemployment metrics that ignore people who have given up looking for work or are underemployed. The real number of unemployment and underemployment reaches 12% of the workforce, double what is reported in official headlines. Food inflation has risen 25% since 2021, while the debt ceiling continues to be raised annually without any structural reform. Each debt ceiling hike is a promise that inflation will continue to be the official policy to pay public bills. Institutional investors are fleeing cash and seeking tangible assets, which further inflates the price of homes. This creates a barrier to entry for the youth, turning the United States into a nation of tenants dependent on credit. Consumer behavior has shifted to doom spending, where people spend because they don't believe they will ever be able to save enough. Without hope of buying a home, young people spend their income on fleeting experiences, destroying capital formation. Total debt, combining government and the private sector, exceeds $100 trillion, about 4 times the size of the real economy. This 4-to-1 leverage makes any small variation in interest rates a catastrophic event for the liquidity of the entire system. The prospect of total repayment is mathematically impossible, which will lead to a debt restructuring or controlled hyperinflation. Economic historians point out that this is the final stage of a credit cycle that began after World War II. The population is reacting with skepticism, seeking refuge in digital currencies and gold, whose prices hit successive records in 2024 and 2025. This signals that trust in government. Paper money is at its lowest level in modern American history. The cost of healthcare in the U.S. now consumes 17% of the GDP, financed mostly by government debt and expensive insurance. This system is inefficient. It spends twice as much as other developed nations to achieve lower life expectancy results. Each American citizen is born with an individual bill of $115,000 just to cover their share of the current public debt. If we had private debts, every 18-year-old starts life with a theoretical liability of nearly $500,000. The country's infrastructure, rated at a C level by the Society of Engineers, needs $4 trillion that the government does not have. Bridges and roads continue to degrade because money is sucked down the drain of debt, interest, and current deficits. U.S. geopolitical strategy is also affected, as the country can no longer project military power without issuing new trillions in debt. This encourages new economic blocs to challenge the dominance of the dollar in international oil and commodity transactions. Human development is stagnant in rural areas where the closure of regional banks has eliminated access to local productive credit. These regions face an opioid and unemployment crisis fueled by the lack of investment in basic human capital. Data shows that productivity per hour worked has stopped growing in the same proportion as the operating costs of leveraged companies. This creates a ceiling for wages, preventing workers from overcoming the inflation of essential assets like housing. For the investor, the scenario requires moving away from traditional fixed income and seeking protection in international cash flows and intrinsic value assets. The Treasury bond market no longer offers a positive real return when we discount true inflation and taxes. The political class avoids the topic of austerity because a $1 trillion spending cut would cause an immediate 4% drop in the national GDP. The country has become addicted to fiscal stimulus to maintain the illusion of growth, creating a chemical dependency on new loans. In the long run, the only way out is a massive increase in productivity via technology, but current debt suffocates risk-taking investments. We are in a race against time where debt grows at 8% a year while technology delivers gains of only 2%. Human beings under constant financial pressure lose long-term vision and start making decisions based on fear and urgency. This alters the consumption and investment behavior of an entire generation, which now prefers immediate liquidity over wealth building. Statistics show that 20% of all American currency in circulation was printed in the last 4 years, diluting the value of work. This injection of liquidity is what keeps stock markets high, but at the cost of record-breaking and explosive social inequality. The next 5 years will be decisive in determining whether the United States can achieve structural reform or if it will face a market-forced adjustment. The time for ignoring the numbers is over, and the reality of $38 trillion in debt will knock on every citizen's door. Stay tuned to interest rate and delinquency indicators, as they are the early warning system that the credit limit has finally been reached. The economy is based on trust and mathematics. When the mathematics fails, trust is the next thing to disappear from the global market. The journey to individual financial freedom begins with understanding these numbers and protecting your capital against monetary dilution. Do not expect the system to solve the debt problem, as the system is today the largest debtor and the most interested in inflation. What is your take on these percentages? Can the U.S. reverse the interest curve, or will inflation be the only way out for this $38 trillion debt? Comment with your opinion based on the data presented. Subscribe to the channel for technical analysis and leave a like if this content brought the clarity you needed.